Don't forget to subscribe and like, what if a market keeps moving higher, but the buying pressure is actually becoming weaker? Price is making higher highs. Price is also making higher lows. Everything looks bullish, but underneath the surface, something is changing. The price range is becoming smaller, volatility is decreasing, and the two trend lines are beginning to converge. This is called a rising wedge. And in today's video, I'm going to show you how traders can use the rising wedge to identify a potential bearish reversal and trade the breakdown. We'll cover how to identify the pattern, how to draw the trend lines, how to confirm the breakout, where to enter, where to place the stop loss, and how to calculate the target. Let's start with the basic definition. A rising wedge is a price pattern where the market continues to rise, but the upward movement gradually becomes weaker. Price creates a series of higher highs and higher lows. However, the upper and lower trend lines begin to converge. The distance between the highs and lows becomes smaller. This creates a narrowing structure that looks like a wedge pointing upward. The important idea is that price is still rising, but momentum may be slowing. That is why the rising wedge can become a warning sign that the current bullish trend may be losing strength. So why should traders pay attention to this pattern? Because the market can continue moving higher while the strength behind that move is gradually declining. Imagine a group of buyers pushing the market upward. At first, the moves are strong, but as price continues higher, each new move becomes smaller. The market still makes new highs, but the distance between those highs becomes less significant. At the same time, volatility may decrease. Volume may also decline during the formation. This doesn't mean the market must fall, but it tells us that we should pay close attention to the support line underneath the pattern. If that support breaks, the market may experience a much stronger move downward. Now, let's identify a high-quality rising wedge. There are 4 important characteristics. First, price should generally be moving upward. Second, we want to see higher highs and higher lows. Third, we need 2 upward sloping trend lines. And fourth, those trend lines should converge. The upper trend line connects important swing highs. The lower trend line connects important swing lows. As the pattern develops, the distance between these 2 lines becomes smaller. Don't force a rising wedge onto random price action. The structure should be obvious. If you need to constantly adjust the trend lines to make the pattern fit, it's probably not a clean setup. Let's take a closer look at the 2 trend lines. The upper trend line acts as resistance. It connects the important highs created during the formation. The lower trend line acts as support. It connects the important lows. As price moves upward inside the wedge, it repeatedly moves between these 2 boundaries. But eventually, something important can happen. Price breaks below the lower support trend line. This is the key signal we are waiting for. The rising wedge itself is only the setup. The breakdown provides the confirmation. This is the most important part of the strategy. The breakdown. A common mistake is entering a short trade simply because a rising wedge has formed. That's too early. Price can remain inside the wedge much longer than expected. Instead, wait for price to break below the lower trend line. Ideally, we want the breakout candle to close below the support line. This gives us stronger confirmation that sellers are taking control. In our example, price breaks below the lower trend line and begins moving downward. This is where the trading opportunity develops. Now let's discuss the entry. There are 2 common approaches. The first is the immediate breakdown entry. After price closes below the lower trend line, a trader can consider entering a short position according to their trading plan. The second approach is more conservative. Wait for price to break the support line, and then look for a retest. Price may return to the broken support area. If the old support now acts as resistance, and sellers appear again, the retest can provide a more structured entry. This approach can help traders avoid some false breakouts. But remember, not every breakout will provide a retest. Sometimes price will continue moving lower immediately. The important rule is to decide your entry criteria before entering the trade. Once we have an entry, we need to define our risk. For a bearish rising wedge breakdown, the stop loss can be placed above a logical swing high or above the broken structure, depending on the setup and time frame. The exact location depends on market volatility and the structure of the chart. The important point is this. Don't place your stop loss based on emotion. Don't say, "I'll just use 10 points." Instead, identify the price level that would invalidate your trading idea. If price breaks back above the structure and the bearish setup is no longer valid, we exit. Then we move on to the next opportunity. Now let's talk about the target. One common method is to measure the height of the rising wedge at its widest point. Then project that distance downward from the breakdown area. For example, if the widest part of the wedge measures 100 points, the measured target could be approximately 100 points below the breakout. But this is not a guarantee. Before setting the final target, look at the chart. Are there previous support levels? Are there major swing lows? Is there a psychological price level? These areas can become potential obstacles for the trade. The target should always be considered together with the market structure. Now let's look at volume and volatility. During the formation of a rising wedge, traders may observe decreasing volume and decreasing volatility. This can indicate that the market is becoming more compressed. But when the breakdown happens, we want to see stronger participation from sellers. An increase in volume during the breakdown can provide additional confirmation. Volatility can also expand as price leaves the wedge. However, remember that volume and volatility are confirmation tools. They should not replace price structure. The most important signal remains the price breaking the wedge support. Now let's talk about false breakouts. A false breakout happens when price briefly moves below the support line, but then quickly returns inside the wedge. This is why traders should avoid reacting emotionally to every small movement. Wait for confirmation. One possible confirmation is a candle close below the support line. Another is a breakdown followed by a retest. If price breaks down and immediately moves back above the trend line, be careful. The setup may not be ready. And remember one of the most important rules in trading. You don't have to trade every pattern. Sometimes staying out is the best decision. Let's put the complete strategy together. Step 1. Identify an upward moving market. Step 2. Look for higher highs and higher lows. Step 3. Draw the upper resistance trend line. Step 4. Draw the lower support trend line. Step 5. Make sure the two lines are converging. Step 6. Watch for decreasing momentum, volume, or volatility. Step 7. Wait for price to break below the lower trend line. Step 8. Choose your entry. Breakdown and retest. Step 9. Place your stop loss at a logical invalidation level. Step 10. Calculate your target using the wedge measurement and nearby support. And finally, follow your trading plan without emotional decisions. Before we finish, there is one important point. A standard rising wedge is normally considered a bearish setup when price breaks downward through the lower trend line. So after a confirmed downside breakdown, traders generally look for a short or sell setup. If price instead breaks upward through the upper trend line, that is a different scenario. In that case, a bullish trade may be considered, but it should not be confused with the standard rising wedge bearish breakdown strategy. Always trade according to the actual direction of the confirmed breakout. Let's review the complete setup one final time. Price moves upward. The highs and lows continue rising. The two trend lines begin to converge. Momentum and volatility start decreasing. Then price breaks below the lower trend line. We wait for confirmation. We identify our entry. We define our stop loss. We calculate our target. And most importantly, we follow our trading plan instead of reacting emotionally. The rising wedge is not a guarantee of a profitable trade. It is simply a structure that can help us identify a potential change in market direction. If you found this strategy useful, subscribe to Trade Tactics TV for more trading strategies, technical analysis, chart patterns, and practical trading education. And remember, trade the setup. Don't trade your emotions. Protect your capital first.